All right, good morning, everybody. Today is the 13th of November, and we are picking up from where we left off last time, talking about Chapter 11. And we're still sort of working our way through the balance sheet, which, as I mentioned to you in previous class sessions, this is a lot of what intermediate accounting is sort of a deep dive into the financial statements, balance sheet, income statement, cash flow statement, etc. And so we're sort of working our way down the left side, the asset side. And we've been talking about long-term assets, property, plant, and equipment in particular, but also intangibles. And in chapter 10, we talked about the acquisition, excuse me, the acquisition of those and how we book those values on the balance sheet. Here in chapter 11, it's a little bit lengthier of a chapter, so which is why I sort of elongated and extended the due dates with the activities. It's more about how we use them and how we expense the cost over time, how we allocate the cost, whether it's depreciation, depletion, amortization. So that's really sort of the theme of what Chapter 11 is about. And so the due date. So there's really nothing to do this week. I know last week we had Chapter 10's work to be done. Everything is going to be due next week. So next Friday, the quiz, and there's also discussion activity. So just make sure you post a discussion activity if you would, and just kind of follow the directions, kind of follow the prompts there. Just kind of I put a little bit of emphasis and attention to that. I think it'll pay off in dividends if you do that. And then the homework for that chapter on Sunday the 23rd. Okay. So what my plan is for today, I want to just keep sort of moving in to some of the details, some of which are essentially descriptive of methods by which we allocate cost over time, or how we treat disposition of assets. And again, the term disposition really, it doesn't necessarily mean sale. It can mean the fact that we've simply discarded the asset because it's no longer of any use to anybody. It is true scrap value, and so we sort of treat it as that. Or we can exchange it for another asset, or the asset lives on after its depreciation period. So so those are things that we really have to contend with here. But there are also special situations, and I think that's really what when I think of intermediate accounting, I think of the idea of methods and techniques by which we handle situations that come up. And professional accountants will say, okay, well, I've seen this before. I know what to do, and this is what we have to do in this circumstance. And by the way, in the real world, if you have questions about this, there are all kinds of resources that one can guide oneself to in order to sort of figure out what to do in strange situations. Fortunately, on a day-to-day basis, the strangeness does not always rear its head. So for the most part, I think a lot of this is routine, but it's routine only to the extent that we know what's happening. So I think that's really what's going on. So that's what's going on with Chapter 11. When we come back on Tuesday, I'll talk more about, and I probably am not going to finish even in our class discussion, 10:30 on Tuesday, enough content. So I'll probably do a supplementary video. Just, it's a dense class. There's a lot going on here. And so I'll probably supplement that, hopefully before the end of the week, before the time of these assessments are due. When we come back the week after that, we'll talk about current liabilities and contingencies. And so we're going to sort of move our way over to the right side of the balance sheet. That is the equities side, not the asset side, which we've been covering, but the equity side. And that's where we're going to sort of stay for the rest of the semester. And again, intermediate accounting is often sort of described as a walk around, as a deep dive into the financial statements that we've all been exposed to previously. So, okay. All right. So let's pick up from where we left off last time. I think we were talking about intangibles, and I think this is about as far as we got last time. When we talked about intangibles, and I think we actually talked a bit about this idea before, but whether it has a tangible, useful life or an intangible life, and I think that's really the big question here. And I know we may have covered some of this ground before, so but maybe it bears repeating if it does. But when we talk about intangibles, again, what we're talking about is we're going all the way down, pretty much to the bottom of the balance sheet on the left side, on the asset side. And remember, we move our way downward on the asset side in order of liquidity. And liquidity simply means the ability to convert something to cash. Now, we can convert intangible assets to cash, but do we want to do it? I mean, presumably, an intangible asset's got long-term value in terms of product development and branding and a lot of things that really are at the core of what the business is about strategically. So I mean, they're really not that liquid. I mean, I'm not saying they're never liquid, because they can be exchanged, over time, but they're probably not. So, which is why we sort of drop them down to pretty much the very bottom of the left side of the asset side of the balance sheet. So, so again, and we talk about legal rights, and that's so patents, copyrights, trademarks are the big ones here, and they've got different useful lives, and in some cases there is no useful life. And the one thing that we have talked a bit about, we'll get to a bit more, is goodwill. And goodwill is simply, for lack of a better way to put it, sort of a plug number that sort of represents the sales price of usually what is an entire company or maybe an entire division or subsidiary of a company. That difference between the sales price and the fair market value of the assets, which are actually being somehow appraised prior to the purchase. And so it becomes an asset on the part of the acquirer and is not amortized. And the reason why it's not amortized is because the value of that goodwill is indefinite. We don't know how long it's going to be. And it seems like, I think about a long time ago, and I've been at this a while, we used to amortize goodwill, but we no longer do that because it's really hard to know, first of all, what useful life to sort of set for the amortization schedule. And do we straight line it? Do we accelerate it? It's really difficult to know. And so the thing that we should know about reducing the value of goodwill, other than this sort of systematic reduction over time that we call depreciation, depletion, and amortization, which is a cost allocation method, the thing to know is that we can definitely reduce the value through what's known as impairment. We've talked a bit about impairments. We're going to talk more about impairments. Impairments are really these this effort to decide if a long-term asset is really what it purports to be. And if it is not, we need to reduce the value, and it really becomes an expense at that point. So when it comes to finite useful lives, we amortize it. So patents are a perfect example. A 20-year patent on a drug that does, weight loss or diabetes or whatever, we simply amortize the cost of that over time. That patent, because and what gives that patent value? It's a legal right to essentially charge a monopoly price. That is a price far higher than what would be the case in a competitive market. But in a case in which there are no competitive, say, drugs in this case, and I bring up the drug industry because it's sort of a single example of this particular use of patents. They charge very, very high prices, and for those of us who take prescription drugs, I'm not seriously ill, but I do have asthma. One of the drugs I take, which is an injectable, is an extremely expensive drug. If my insurance didn't cover it, I'd pay something like $2,800 a month out of pocket, which I probably would not do. I would probably go somewhere else and try to find some other solution, but my insurance does really cover it, so that's a good thing. But my point is, though, that the patent has value, and because the patent has value, but it's going to diminish over time, and that diminishment of value is really what we refer to as amortization. And in fact, amortization, a lot of accounting theorists would say, is sort of the blanket term for all of these other cost allocation methods that occur over long time periods, whether it's depreciation or depletion. Amortization is sort of the signal concept. So what about this depreciation method? So if it's intangible, like a patent, copyright, trademark, we can depreciate over time. Or if it's intangible, then we cannot amortize it, but we can impair it if that asset becomes impaired for whatever reason, such as goodwill or whatnot. So I think these are important things for us to sort of latch onto and understand initially what's going on. So, and again, this is one of those tables that appear in the text, and so it doesn't really behoove you to listen to me going through line by line, because I know you can read here, but here are the specific categories of intangibles: patents, copyrights, trademarks, franchises. Trademarks are interesting because these can go on for really an indefinite period. And trademarks would, as I understand it, I am not an attorney, but as I understand it, could include things like logos, slogans, identifying characteristics of a company and whatnot. And as long as the company renews it every 10 years, nobody else is going to intrude on that. So, and trademarks also include things like symbols, which is why if you try to, print T-shirts that have the UNM logo on a T-shirt, try to sell them, the logos should, if they exercise their rights, come after you, which is why they cost more. If you go to Walmart to buy a UNM t-shirt, it's going to have the logo on. It's probably $10 more for that as opposed to a t-shirt without the logo. So there is value because nobody else is really entitled to do that unless they have acquired the rights from the trademark holder in this particular case. Copyrights are more dealing with intellectual property. We've talked about this before, so I don't want to sort of go over this a lot, but what we're really talking about here is how we allocate the cost. And so copyrights, the life of the creator plus 70 years, that's a long time. So if it's a cartoonist that has done a cartoon, they usually it's his heirs, person's grandchildren, grandchildren own that copyright until it goes away, and it's gone at that point. Trademarks can be renewed indefinitely. Franchises we talked a bit about, that's really not the main focus here, but patents certainly are in terms of the amortization of the value of the patent. So we do want to amortize it over time, and it's done on a straight line basis for the most part. So really the only time that I think we can see accelerated depreciation is on machinery and equipment, things that are depreciated. Then we have these issues of accelerated depreciation, whether it's declining balance, aka double declining balance, or some of the year's digits, or whatever the case might be. Okay, so we talk about goodwill. We've come across goodwill before. Goodwill is simply this plug number that simply represents the sales price of what is usually an entire company, or I mean, it may not be an entire company. It may be the division of a company that does. You're buying a company you're a company that makes lawnmowers, and you're buying one particular division of another competitor that makes just lawnmowers. But they also do other things. They make dishwashing liquid. They make they have hotels, whatever. I mean, if we can identify separately the segment of the business that's being purchased, and then compare the purchase price against the fair market value of the assets, then we capitalize that difference in terms of goodwill. And it tends not to depreciate over time or amortize over time. And when we talk about this, we should be clear there's value going on here. We have to assume that the acquiring company is not, making a mistake. They're not overpaying, quote unquote, overpaying, that they're paying for something. It could be the clientele, the customer's clients, the client book. It's not always easy to get new customers. I mean, it's one of the biggest challenges in business is to find customers, and this is why marketing is such an important effort, and which is why it's such an important part of business school education. Is the idea that marketing is an important effort. You got to continually find customers. And I know when I was in the business world, we had to continually find new clients all the time. Why? Because we're going to lose clients. We're going to do something that made them mad. They're going to go away, or they're going to go out of business. They're going to stop working with us for whatever reason. So you've always got to get new clients. Now, it doesn't mean you're going to get and keep all these clients, but it does give you a bit of a lead into them as part of the value, which we could capitalize as an asset. Or train employees, that is, if you have a very strong management team or locations. And the list goes on and on as to what things are going on here. You've got a product which is got a competitive advantage. Maybe it's a brand that's really, really super strong and that one is acquiring. And because that brand is strong, it adds to the total value of the acquisition. So as a result, that it makes sense that somebody would pay more than the fair market value for that. And sometimes, by the way, sometimes these acquisition differences between acquisition price and fair market value are very, very large. I mean, extremely large. And so goodwill is oftentimes a very large element on the balance sheet of companies that have acquired other companies. And that's it's mostly because of the fact that first of all, it's what is agreed upon between buyer and seller. And so how do you account for that? You got to find some way to account for the difference between the fair value of assets acquired and the sales price or the purchase price. And so as a result, you have to create this account called goodwill. We no longer really amortize it. It can be impaired, and we'll talk a bit more about impairment in a minute. So because goodwill can't be separated, it's not possible to acquire without acquiring the company as a whole or a portion of it, as I talked about. So, and again, this is sort of what I talked about. The fair value of consideration given minus the fair value of the identifiable assets acquired, minus any liabilities assumed. This would make sense, right? So you're acquiring $1 billion of assets from a company, but you're also acquiring $3 million or $300,000 of their debt. So you're going to reduce the fair value of that by $300,000. So because you have an obligation to pay. So, and this is not terribly unusual in acquisitions where an acquiring company also acquires not just the assets, which they want, but also they acquire the liabilities, which they have to assume because no one else is going to pay them. So they assume those liabilities, but those liabilities then reduce the value of the transaction because of that, whatever that amount is. And so and we say fair value of liabilities. Well, it's fair value on asset on the asset side is a little bit trickier. It's not as tricky, I think, on the liability side. It's pretty much what is owed. That's essentially what's going on. Maybe you mark it down a bit for some other issues, but probably not. So, all right. So here's an example. The Smithson Corporation acquired all the outstanding stock of the Ryder Corp in exchange for $180 million cash. Smithson assumed all of Ryder's long-term liabilities, which have a fair value of $120 million. Right, that's a pretty big percentage of the total assets acquired. And the fair values of all identifiable assets are as follows: receivables $50 million, inventory $70 million, PP&E $90, and patent of $40 million. So as a result, what's really going on here? Well, all right. So $180 million is the amount paid in cash, right? And the fair value of the assets are as such: $250 million minus the liabilities of $120. And so as a result, 250 minus 120 is 130. So how do we make up the difference? It's got to be goodwill. And again, I don't want goodwill to be thought of as being somebody who's being cheated and it's just some made up fictional sort of number. A company agrees, buyers and sellers agree on the price, right? And again, I think I've said before that price is a very flexible and sort of fungible thing. I mean, the price of the price of Ford stock today could be $13. Next week it'd be $12. Well, who's to say what the price of that thing is, right? Prices vary, and so it's subject to negotiation. Contracts between buyers and sellers, and if you don't like the price, don't do the deal, right? Whether you're the buyer or the seller, right? So that's kind of an idea. So $50 million here is the plug value that creates goodwill, and so that's essentially what's going on. So the journal entries here look like this. You have all these examples. So we got to go. Well, it's reproduced here. So 50 million for the receivables, 70 million for inventory, PPD, patent, goodwill. The goodwill becomes a debit because it's an asset, and then the liabilities, which were assumed, are 120 million, and because now they enter the books of the acquiring company, they flow into that acquiring company's books on their balance sheet as a liability, a credit balance of 120 million, and the cash expended was 180 million. And so that's the journal entry for this. And again, we're not going to slice and dice this so thinly as to get into things like transaction costs and attorney's fees and accountants that are specifically related to that. There are probably other attending areas that go on with this, but they're really immaterial related to what we're doing here. Okay, so that's an example of how goodwill enters the balance sheet. One thing I'll say before, and I've said, I think this is not the first time I've said it, is goodwill is not something you can create on your own. You can't internally generate goodwill. It's got to be created through acquisition, and that's one of the things that I think we need to understand is that goodwill doesn't just we can't just mark up our assets and say, hey, or the value of our management team and say, hey, we're going to mark everything up by $100 million or whatever the number might be, because what's to stop everyone from doing that and really overinflating not just assets but equity in the company and a shareholder's position and whatnot. And where does that number come from in the first place? Well, and this goes back to why. So how does that differ from I'm acquiring these same attributes, management expertise, brand strength? How does that differ from our internally created goodwill? It differs in the sense that we're acquiring it. It's an arm's length transaction, and the buyer wants to pay a low price, the seller wants a high price. We know that. So this is probably the best measure we have, as imperfect as what it might seem, in order to establish what the value of those assets are and the value of all the other sort of things, some of which are not even balance sheet items like management expertise and the value of a brand. And I am not a marketing person, so I'm on thin ice here when I talk about the value of a brand is, but there's no question that brands have value, right? If you're driving down the road and you want to find a hotel, are you going to stay in something that's like ABC Hotel, or are you going to stay in days in, for instance, right? You're probably going to go the days in, all else remaining equal, because it's a brand and whatnot. So you kind of have some assurance of quality and whatnot. And again, I've taken my share of marketing courses, but I do not want to hold myself as a marketer. So, but as an accountant, in the sense that there is value in that particular brand. So, all right. So another example here: the Dearden Golf Ball Company acquired all the outstanding stock of Sanderson for $1.75 million. The book values and fair values are as follows. So the book value, so we have current assets, book and fair for PPD and liability. So Dearden should record goodwill of what? Well, remember, we're going to key off fair value here. So 415 plus 1.47 million plus 300,000, and the sales price is 1,750,000. So the math works out like this. We add these fair values at 415,000 plus 1,470,000, and we're going to take out the value of liabilities, because remember, liabilities we're assuming, so we're taking liabilities off of their hands and putting them on our books. In other words, liabilities they define as obligations, future obligations, and so we're going to subtract that. And so as a result, 1,750,000 minus the sum of these is going to give us 165. And so the answer is going to be A, 165. This is a pretty common example of what I think you might see in the homework and quiz type scenarios in Connect. Remember, you have to deduct the value of liabilities acquired, right? It's one thing to acquire assets, right? Because assets have future service value. Liabilities have future service obligations. So as a result, we have to deduct that from the sales price, because we're actually taking them off the hands of the acquiree. And so as a result, we have to reduce the sales price as based upon that. Okay. Okay. Any questions so far? Whether we've for anybody in the classroom here or on the Zoom call right now. And again, if you're on the Zoom call, you can always put a note in the chat box if you like. I'll try to get back to this. I circle back to it. So, all right, let's talk about some, and we're going to get into a section here where we talk about all kinds of different kinds of transactions, some of which might seem a little bit odd, but they're really not that odd. They do happen. I mean, it's not maybe an everyday occurrence on the part of a lot of firms, but they do happen. And one of those is called a lump sum purchase, where we're buying a group of assets, whether it's a group of, and I think of vehicles here, a group of trucks, a group of taxis, a group of, I don't know, whatever, machine tools, printing presses, whatever the case might be, where they differ in the sense that each asset is really sort of indistinguishable from one another. So the example, and of course the example they use here, is one that kind of fits my logic, and that's 10 identical delivery trucks purchased for a lump sum price of $150,000. They have different characteristics. They were bought at different times. They have different useful lives. They may not even look that much alike. They may have different mileage on them. They may have a lot of different things. But we're going to say, okay, and remember, this is one party buying another party's assets. We're going to agree on a sales price, which in this case is going to be $150,000, okay, for these assets. And so the question is, how do we allocate these among the separate items? Okay, and what do we do about those? And so, or another example is a factory includes assets that are much different, like land, building, and equipment. And that's a different sort of animal here, really, because it's one thing in this case to have delivery trucks. Trucks are trucks, right? And I know that trucks are not trucks because they've got different useful lives, purchased at different dates, different mileage, different expected life and whatnot. But this is a different deal altogether, where you have a factory that includes things like land and different kinds of equipment and building and whatnot. So, but nonetheless, we can still treat that as a lump sum purchase. And so we have to kind of look at it. So let's give you some examples here. So the Smyrna Hand Edge Tools Company purchased an existing factory for a single sum of $2 million. The price included title for the land, the building, the manufacturing equipment, a patent on the process the equipment uses. Okay, so they've acquired a patent. All right. And inventories of raw materials. And so there's a lot of different disparate kinds of assets going on here. And it doesn't look like there's any liabilities that are being assumed. And so here are the fair values, okay? And the fair value, and the fair value comes out to $2.2 million versus the sales price of $2 million. Now you're thinking, okay, what's happening here is the company that's selling, are they selling out for too low a price? I don't know. It doesn't really make any difference. It's not, all we're really simply saying is the sales price is $2 million. What we have to do is allocate these individual categories of assets based upon their relationship to fair value. So the land is estimated at unappraised value. We're assuming it's an independent appraised value, 330,000 divided by 2.2 million is 15%. 550 divided by 2.2 million is 25% and whatnot. And we're going to take these percentages and we're going to apply them not to this, but to this, so that we can book these on the asset side of the balance sheet as long-term assets. Because of the fact that we're saying this is the percentage allocation, the percentage share of asset ownership that should belong to these different categories. And that's why we sort of got into this example where you're buying not just a fleet of trucks, which are trucks of trucks, maybe sort of thing, but you got all kinds of different types of equipment, land and building equipment. These are all kinds of different things, even inventories, right? Which is a current asset, right? And you know, who knows we're still talking about current assets, right? So we take these percentages, 15, 25, 30, 20, whatnot, and we're going to apply those to the, oops, what do we got? Oh, shoot, what happened here? Oh, I think I lost my way here somewhere. And we're going to apply those to the purchase price. I don't know what happened here. Whoa, this is weird. All right, give me a second here. Give me 1 second. Okay, I apologize for that. I don't know what happened there. I think we've kind of lost power. Whoop, we lost power again. Oh my God. Hold on a second here. Let me see what's going on here. Give me just a second here. Okay, it looks like we have some intermittent power issues here, which I don't quite understand, but nonetheless, this is what's going on. So when it comes to purchases, you're taking the same percentages that we talked about before, 15, 25, 30, etc., and spreading these now at over a cost of $2 million. And we're going to have the book value of those assets now at 3 million, 300,000, 500,000, etc. And these become the asset values that go into the asset on the asset side as debit balances. Okay. All right. So let's talk a bit more about where we are here. Remember, chapter 11, and we talked a bit about the idea of acquisitions and whatnot, but I want to sort of get back to the concept of dispositions here and talk a bit about what's going on with dispositions. And that is the idea of depreciation methods that we're sort of being faced with. And remember, when we talk about what chapter 11 really is about, not so much acquisition, it's, you know, some of it's disposition, certainly, and we get into how we exchange one value of an asset for another asset value. But a lot of it is how we treat the asset over time as we're sort of using this, okay? And again, the idea of depreciation is an allocation method that we're looking at here. So in this case, we have an example, April 1st, 2021, Hogan Manufacturing purchased a machine for $250,000 and made the following estimates. That is residual value of $40,000, estimated life of 5 years, estimated production of 140,000 units, and the company's going to December 31st year end. Okay, and so not all these facts are going to be necessary, okay, at all, but some of them are. And so what are we going to do with this? Well, when we talk about the use of assets, remember, chapter 11 deals with the use of assets, and ultimately there's disposition, however that disposition comes about. But as these assets are in service, we have to depreciate them, and we can use a number of different methods. We talked about what those are. So the year end is December 31st, which makes our life easy. But remember, the acquisition date was April 1st. So they really owned this property for 9 months. So what do we do here? All right, well, if you take straight line depreciation, you're going to have an even amount of depreciation every year. This is the example we saw last time that we sort of picked up and discussed. And we also did a comparison between that and double declining balance, which is an accelerated method where we pick up a lot more in the early years. In fact, toward the last year of the service value, there's really no depreciation being earned because we've already taken it. And the units of production is quite variable. So it really depends upon what method we're using here in order to sort of account for a lot of this. And so that's really what is going on here in terms of the accounting for that. So remember, so let's flip back the acquisition date, which was April 1st. Okay. And so in the first year, assuming we're using, well, any method, right? And so in straight line, which is this category here, 42,000 times 3/4 of a year, or 0.75, whichever you prefer, which is the fractional year, we're going to take $31,500. But then we have full years of 2022, 23, 24, 25, where we simply take 42,000, which we arrived at as cost minus residual over the estimated useful life, which was 5 years. And we're going to depreciate always under straight line down to its residual value or salvage value, whatever you want to call it, down to that particular value, which I think was, what was it, 40,000? Yeah. So we're going to always depreciate down to that. So in the final year, we've only got one quarter of the year, that's 3 months. And altogether, we have 60 months altogether. If you take, 12 is 48, plus 9 is 51. 12 is 48, plus 9 is 57. I'm sorry, plus 3 is 60. So it's 5 years. And so as a result, we have all years being accounted for. Under declining balance, which is double declining balance, and I don't know any other, I guess I've come across some other examples of declining balance, which, get into, I don't know, triple declining balance or double and a half and whatnot. But double declining balance is not uncommon. And in fact, as I mentioned on Tuesday, it's the standard by which the maker's tax depreciation is based. And so if you take the 5-year property, which would depreciate in straight line over 20% per year, 20% a year, 5 years. Here we're taking 40% in the first year without regard to salvage. So 250,000 is 40,000 times 3 months, or I'm sorry, 3/4 of the year, or times 0.75, is going to give $75,000 in that first year. Okay. And again, we would expect this to decline over time, but essentially what's going on is we take whatever the book value is remaining after that, 75 away from 250 is 175, times that same 40% rate is going to be 70,000. We take that away from 175 is 105, times 40% is 42,000. We're going to get to residual value, 40,000, much faster that way, but that's the intent and that's the purpose of it. Okay. So there are different methods by which we log in depreciation and we record it, and they have different purposes in this regard. And the units of production method simply is an activity-based method, not a time-based method at all. And so we're going to end up with whatever the results are in terms of actual activity. Okay. So that's essentially what's going on here with that. So quick question: a machine is purchased on September 30th of 2021 for $30,000. Useful life is estimated at 4 years, and no residual is anticipated. Double declining balance is used, and so the acquiring company's fiscal year ends on December 31st. So what should be the depreciation for December of 2022? Well, first of all, we have to look at 2021 first. Because that was the purchase date, 30,000 was the purchase price in 4 years. And so here's what the math looks like. So we do the first year depreciation, 30,000, right? And it's got a 4-year useful life. So 4 years, 100% times divided by 4 is 25%. We double that percentage and make it 50% the first year, right? But it's only a fractional year. It's only between September 30th and December 31st. That's why we have the fiscal year indicated here. So 3/12 or 0.75, you get 3,750. But we're going to keep the same percentage throughout. Okay. And so we simply take the next year, 30,000 times 50% times 9/12 is 11,250. Okay. Now we subtract, so we've gotten to this issue where we've taken the first full year of depreciation. And now we want to take the next year, which goes into 2022, 30,000 minus 15,000, because remember, in declining balance, we're reducing that basis, that depreciable basis, by the amount of previous depreciation. So it's going to be 15,000 times 50% times 1/4, which is the next year, because we bought it on September 30th, is going to be 1875. So as a result, what we end up with here is this plus this equals that. and it's going to be 13,125 as the depreciation for 2022. And this is important to note because in real life, obviously, we don't buy assets on January the 1st or December 31st, or we don't dispose of them on December 31st or whatever the case might be. We're doing it all throughout the year. And as I mentioned, I think before in a previous discussion, that we usually, if it's between the 1st and the 15th of the month, accountants will simply say that's the full month. If it's after that, even if it's 28 days, 29 days, we're going to say it's the next month. So it's not all that difficult. And those differences generally are not that significant over time. It probably is not a great distortion of earnings, but this is sort of a convention that is used in booking assets that are depreciable on this particular basis. Okay. All right. So let's kind of move on here. We talk about disposition of assets. And one thing that we mentioned with disposition is the idea that assets can be sold and or they can be destroyed, they can be lost, or they can be impaired for whatever it means. Impairment's not quite the same as disposition. It really isn't, because we can have an impaired asset that we don't dispose of. But the point is that we can mark down assets and take them off the books. And that's really what is essentially going on here. And so outside the issue of impairments, let's talk about dispositions. And we can have a gain or loss based upon book value, okay? And why would book value differ from the actual sales price? It's because the fair market value may differ from the book value. This is not unusual whatsoever. The idea that we would dispose of an asset and somebody's willing to pay us more than what the book value is. But the book value is simply the cost minus any accumulated depreciation if it's an asset that does depreciate or amortize or whatever the case might be. So in this case, we have a gain or loss that recognizes between the difference between the consideration received, i.e. the fair value, and the asset's book value. So in this case, we have generic numbers, sales price, whatever it is, minus the original cost, minus accumulated depreciation, gives us the net amount. So the difference between the sales price and the net amount of that asset gives us a gain or loss. A gain is going to be booked as a credit on the income statement, right? It's a gain on sale. It is not an operating item. It goes down toward the bottom of the income statement so that people aren't confused about what's going on. If it's a loss, it goes to the same place, but it's a debit balance because it's a reduction in the price of the asset, and it's not unusual at all to sell an asset either at a gain or a loss, and so we have to sort of record that difference, whatever the case might be. All right, so let's go back to our Hogan people here. January 1st, 2021, Hogan purchased a machine for $250,000. So it's the same scenario as before. And the company expects the service life to be 5 years. Same facts, residual value, $40,000. Using straight line, okay, easy, all right. Suppose Hogan decides not to hold the machine for the expected 5 years, but instead sells it on December 31st of 2023. I know we're making these things easy when we start acquisition January 1st. Disposition 12/31, but all we have to do is fractionalize this when we do the math, but we are making it easy. So it's a 3-year holding period, and they're going to sell it for $140. So first of all, what we have to do is we got to update the book value of this asset, right? So this asset's going to be leaving our books, right? And because we don't want to hold it for 5 years, for whatever business reason we have in mind, we don't want this asset. Maybe, I mean, who knows what's going on. So first, we have to update it through an adjusting entry. So depreciation for 2021 and 2022 has already been recorded, but we're in 2023 now. So we have to update the new depreciation, which is since a straight line is easy peasy. And we brought the book value down to 126. Okay. And so with just in this simple entry here, a very simple entry is simply 42,000 depreciation expense. Debit balance, accumulated depreciation, 42,000. But now we're going to do the sale. And so as a result, we're selling for 140 against a book value of 124. Where did that come from? 124. Remember, the book value is accumulated depreciation is 126. The original cost was 140, right? I'm sorry, 250 minus 126, which gives us 124 as that book value. And so as a result, 124 is the book value, but we're selling it for 140, and so as a result, We have a $16,000 gain. So here's the journalization of this transaction. We debit cash for 140. That's the sales price. We remove this and this. That is the original book value, which is obviously it's an asset, so it would be a debit balance. But now it's leaving the balance sheet. So we're going to clear it out by crediting it and accumulated depreciation, the contra asset, which is a credit balance account. We're clearing that out by debiting it. So we zero out those accounts. And the balancing factor is the gain on the sale, which is a credit at 16,000, which makes this transaction balance. Okay. So we recognize the gain on the sale, and it's not a gain that we would expect to be continual, because we're assuming that the business is not in the actual business of selling its long-term assets, because remember, long-term assets are used in the production of income over the long term, right? In other words, we're booking them as assets to have long-term future service value. And so, but sometimes we need to get rid of things because for whatever reason. Maybe we want to buy a newer equipment. Who knows? The reasons go on and on and on, and we don't really care what's going on here. All we know is the sale took place, and so that's the way we record it. Okay. So a gain on the sale is going to be simply the asset is sold for more than its book value, and the net increase is simply the book value. And it's not necessarily an economic gain. And what we mean, and I underline this because when I underline book value, because one of the things that is, I think, really important to know, and it's something that's important for all accountants to know, is the idea that book value really differs substantially sometimes from market value. So fair market value and book value are two different things altogether, and sometimes they can be wildly apart. This is an area of controversy in GAAP accounting. It's a little bit less controversial in international standards, as we're going to get to in a second, but there's definitely a difference between book value and fair market value. But yet, if we're going to sell an asset, we're going to sell it not the book value. The book value is completely irrelevant to the buyer. Why does the buyer care what the book value is? You can use all kinds of depreciation methods and all kinds of estimated useful lives to get to a book value that may not even represent anything close to what the fair market value is. And so that's mostly irrelevant, particularly to the buyer. So in order to balance the transaction, we have to record a gain or a loss in this case. And so in this case, the prior example in the blue tab is an increase in book value. But a loss signifies all that's going on here is we're selling the asset for less than the book value, and all it is a net increase. There's not necessarily a loss or gain in either scenario in economic value. It's simply the way that we make these transactions balance. And because of the fact that GAAP accounting requires initially the posting of an asset as at its historical cost or its acquisition cost, right? We can, if it's something that's depreciable, like machinery and equipment or whatever, we'll bring that down over time. But that's sort of arbitrary. And some assets physically and economically do not depreciate that much over time. And as a result, this is sort of it's not necessarily reflective of what's going on. And this is why we have fair value in the first place, is in order to establish what the heck this value is worth. And we see this everywhere. And one of the big areas we don't talk much about in this course is real estate, where when you think about buying a commercial property, a building, a factory, whatever, where we're depreciating that thing, we're bringing the value of that thing down because it's a prepaid asset. We're going to take it down over, 30 years, 39 years, 39 and a half for tax purposes. We're going to bring the value down. But what if that value is actually going up over time, which we often see with real estate? Then we're going in two different directions. We're depreciating the book value. We're bringing down the book value on a net basis, and we're raising the fair market, or we're not raising, but the fair market value is going up. So you're actually going in two different directions here. So this is one of the major issues that sort of separate GAAP from IFRS standards, is this idea of how we recognize fair value. And we're going to get to some of these discrepancies here a bit, and they're pretty important. And personally, I sort of lean toward the international standards. I think that, and the reason why is not because I'm anti-American or anything like that, but because GAAP accounting is really an American standard. And it's because of the fact that I think they've sort of had time to sort of rethink their conceptual framework, which they're really sort of a work in process still. And they're saying, well, what is the actual, what are we trying to do here in terms of recording assets, and what are we communicating to users So I think there's a lot to be said for that. I do know that historical cost advocates are very passionate about that. So I'm well aware of that, but we have to sort of keep in mind what's going on. So, all right. So again, in chapter 11, we talk a lot about this idea of different scenarios and different situations that might be faced by management and their accountants. And one of these is assets held for sale. So when we talk about asset held for sale, we're talking about an asset that we are designated that it's going to go away. It's going to leave our balance sheet for whatever reason. We don't want it. It represents some business that we don't want to be in any longer, or a piece of equipment or real estate or a holding or a factory somewhere and wherever that we don't want. So all these criteria have got to be met for us to recognize that it's available for sale. And number one, management commits to a plan to sell the asset. In other words, the board has met and said, okay, we're going to get rid of the property and wherever the asset's available for sale in its present condition. Doesn't need to be upgraded. It's ready to go right now. A buyer and seller could get together right now and make this thing happen. There's a plan to get the buyer, to find a buyer. And I think a lot of times we think about real estate here, we're trying to find real estate agents and whatnot to be involved. Or if it's equipment, we're trying to find brokers who are intermediate to the transaction who can put the deal together. It's expected, this is a big one, within 1 year. If it's greater than that, then it's really not considered a held for sale asset. Now we're going to circle, and you might wonder what we're talking about here. We're going to sort of circle back this a bit later, and I think a lot of this comes up in intermediate 2, where we sort of segregate assets depending upon their particular use. And so within a year, we're saying we are going to dispose of this asset, whatever it is, whether it's a group of assets or whatever the case might be. And it's offered a reasonable sales price. We're not, underselling or overselling. It's got to be something reasonable, which in itself is sort of squishy. But in management's actions indicate the plan's unlikely to change or be withdrawn. So an asset classified as held for sale is reported at 1 to 2, and it's going to be lower of what we call the current book value or the fair market value less any cost to sell. Okay, and this kind of goes back to something that you may have come across before in previous accounting courses, called the lower of cost or net realizable value, which frankly is a current assets. Frankly, it's more of an inventory sort of idea. It doesn't really apply to long-term assets, but it's kind of analogous. I know it's not perfect. I know I'm well aware it's not a perfect analogy, but it's the idea that we do not want to overstate the value of the asset. So it's going to be its current book value, whatever it is, cost minus depreciation, or its fair market value, whatever the case might be. And what is more important than the idea of lower cost or net realizable value is the idea of what we call the conservatism principle, where accountants will not represent a value that's greater than what we really expect. And I know that conservatism itself is sort of a confusing topic, and people have sort of chosen to view it the way they want to view it. It is not related to politics, I can tell you that. It's more the idea that we, and accountants do not want to abrogate their mission to report faithful representation, which is one of the key concepts, what's going on to external users. And so we don't want to overstate the case, and conservatism simply means we're going to take the most conservative position possible. If we sell this asset, or the company sells the asset for much, much greater than the book value, well, that's all to the good. Nobody is really, everyone's happy, right? But people are definitely not going to be happy if the sales price is well below the book value, and that has not been accounted for, because that's really the job of accountants, is to make sure that we're not misleading investors or lenders or creditors or whoever the users are. And so the principle of conservatism is something that's really important here. It's again, it's misinterpreted at times, and I get that, but the idea still holds that we want to take advantage of that. Okay, so we're talking about retirements. We got about 14 minutes left, so we've got some time. Let's talk about retirements of assets. There are assets which simply have been used up; they're no longer worthwhile and whatnot. And so sometimes the company will say, "Well, rather than sell it, because who's going to maybe buy it? We're going to retire it." I know my grandfather was a farmer and a rancher for a lot of years, and had equipment that was extremely old. And I mean, we're talking decades old tractors and combines and and fertilizing machines, and he would just simply say, I can't sell this. No one's going to buy it. It's 40 years old. So we just retire the asset. We take it off the books, right? If it's not already, and sometimes it may be depreciated down to its residual value, if it's a particularly straight line method, in which case it's a fairly easy transaction. You just simply remove the asset, remove the accumulated depreciation, and it's gone. There's no gain. There's no gain or loss because no one's buying it. We simply retire it. And so all you're doing is simply doing that. That's all you're doing. In this case, is simply taking the asset down, which is debit balance, which you remove from a credit, by a credit, and the accumulated depreciation, which is a credit balance, you remove with the debit, and boom, the thing goes away. And whatever the loss is whatever the book value is, which would probably be the residual value, if you establish a residual value at the original time of booking, and if you had not changed that. Because remember, we talked about the idea that sometimes companies will say, hey, we thought there's going to be, I don't know, $20,000 residual value at the end of the term. We've discovered mid-term that it's not going to have anything of value at all. And so we're going to sort of change this. And I think we're going to talk more about this in a second. There may be no residual value, in which case this is a very easy transaction. But retirements are the cases in which the asset itself really has no use. And I'm thinking primarily about really worn-out equipment or even computers that are just no longer up to snuff. I remember when I was in the corporate world, we had lots of terminals, not really PCs at all, but terminals we could look at data being hooked into our computers, main office and whatnot. And those things had about, I don't know, 4-year useful life or whatever. And I remember when we got rid of those, we said, no one's going to buy these. Nobody wants these. These machines are just done, right? Replaced by new technology. And so we just wrote them off and said they're gone. I think we did establish a residual value, but I think it was probably a misbegotten misadventure on the acquisition side. So the key thing is we got rid of them, and I don't know where they ended up. I have no idea. I don't really care, but they're gone, and so as a result, they're taken off the books. That would be a retirement asset. And a lot of assets do have that particular characteristic where they're just no good at some point. And and so as a result, we simply have traction. If it was not the case, we wouldn't have junkyards, right? I mean, if you drive around, and see junkyards, there's a reason why that's the case. And it's not just people's, Chevy Malibu that they crashed 2 years ago. It's delivery trucks. It's 18-wheelers and whatnot. And sometimes, these junkyards will sort of pick them apart for things like batteries and wiring, who knows. And that's what they do. That's fine. But from the standpoint of the disposing entity, that asset is zero. And so we want to get rid of it. And that's why we do a retirement. Okay. All right. Now, I talked about this before. This is a really interesting piece of this particular segment where we talked about depreciation methods. And I talked a bit about the composite depreciation, which is very, very similar to how we sort of take depreciation for a lot of disparate elements of what could be classified as one asset. Okay. But before we get to composite, let's talk about group depreciation. These are really two different things. They're sort of similar, but they're not really. So group depreciation will be where you're taking a group of assets together that have similar attributes, like in the green type is my own, all taxis owned by a cab company. They may have been purchased different dates, they have different mileage, different estimated useful lives. Who knows? Taxi cabs tend to go on forever and ever and ever. So, they oftentimes exceed their useful life, but we can depreciate them all together. Why would we do that? Well, we might do it because we have, 400 cabs, and maybe the accounting is onerous to do that. Now, that argument is probably a little less salient today because with computers, but you kind of get the idea because computers will sort of handle depreciation. Even though I know that I've said before that we really want people to sort of understand what's going on under the hood of all these kind of things. But nonetheless, it may not be a great argument, but it's certainly one that's simple, okay? And then we take group depreciation. Composite depreciation is where we get assets that are very dissimilar. And I mentioned this, I think, on Tuesday, when we talked about things like cell phone towers or telephone poles, where you've got way different depreciation time periods, estimated useful lives are all over the place, different assets all together. But for simplicity purposes, we're going to lump them together as a single asset and depreciate over time, and it's acceptable. So composite depreciation, it's a little bit complicated. It's maybe even a little bit more than what we want to do here in intermediate accounting, but it is a method by which we simply group together assets that have different useful lives and collectivize those as one particular asset. So, all right, so let's talk about group. We got about 8 minutes. So express delivery began operations in 2021. So again, vehicles sort of come to mind when we talk about group depreciation. It'll depreciate its fleet using the group method. The cost of vehicles were purchased early in 2021. And you've got different categories here, right? So in other words, when we talk about group, we're talking about different groups: vans, trucks, wagons, right? And these are the costs. These are residuals, the depreciable basis of the cost minus residual, cost minus residual, cost minus residual, and different estimated useful lives. And so as a result, if we add the depreciation together, which is simply depreciable base divided by estimated useful life, under straight line, right? Under straight line, 120 divided by 6 is 20,000. 104 divided by 5 is 20,800. 48,000 divided by 4 is 12,000. So we have 52,800. Now, what are we going to do with that? We're going to divide that back into the cost here, and we're going to get 16%. That's going to be the rate that we're going to apply to all the assets in this group that we have accumulated together, right? And we're doing it for simplicity purposes. And by the way, you might be thinking, well, I mean, okay, what if we're talking about 10 vehicles? How hard is that to do? Well, probably not. But what if we're talking about 30,000 assets of different categories that we can sort of group? You have 10,000, 15 here, another 5,000. I mean, you get the idea. I mean, we could be talking about a lot of assets, and so it's simply a way. And by the way, at the end of the day, and when I say at the end of the day, at the end of the depreciation period, it's all going to be the same anyway. And unless it really distorts net income because of the depreciation expense being taken that may be differing from every single individual asset, it's probably not going to throw it off much. And by the way, you can solve the problem, and particularly in terms of GAAP compliance, by disclosing in the notes what you're doing. This is a particularly there's nothing illegitimate whatsoever about this. It makes it a little bit easier. So, all right, so 52.8 divided by 330 is 16%, which we're going to then apply as the percentage amount of depreciation every year. Knowing, of course, that some of these assets are going to be depreciated off or are going to be physically gone, maybe, if the estimated useful life is anything resembling physical life before this time period is up, because 16 is about a 6-year period. That's actually 5.15 years. So it's going to be a little longer. So in some cases, some of these asset categories, if they were taken individually, would have already been depreciated off the books, but instead we're using this sort of group depreciation method. So it's going to be 5.15 years. Where did that number come from? Simply taken, it's simply the average service life, which is this, divided by 52.8, which is this, is 5.15 years. And this is the depreciable basis upon which we're doing that. So what does this look like? I think the slide comes up here will show what's going on. Oh, I guess it doesn't. I guess it doesn't. But that's what's going on. So we're taking 50,800 every year until this entire group is depreciated down to its residual of 58,000, and we stop depreciating. And assuming a straight line depreciation method, you could use a declining balance method if you want. And remember that double declining balance is also the methods used in tax accounting as well. So it's not illegitimate whatsoever. This particular example uses a straight line method, and it's a little bit less perfect, a little bit less accurate, but it does simplify the work of accountants. And at the end of the day, we're going to depreciate all these assets down their salvage value, and so that's essentially where we're going to end up at the end of the day. Okay, I do want to talk about composite methods before we leave here. So one of the things before we get to that is the idea that this assumes that we go back to the screen here. It assumes that all these assets in all these categories are going to be the same throughout the 5.15 years of depreciation. That's probably not realistic. Some of these assets are going to get crashed. They're going to get stolen. We're going to add new assets and whatnot. In which case, we simply reconstitute that group as we go, and we start over again. And we simply take that new value minus the residual value, and we go on from there. And that's what happens. That's probably the case, particularly when you've got, I mean, if you have 30,000 vehicles and whatnot, and you're a trucking company, and I mean, you're probably some of those are going to crash. Probably some of them are going to be out of commission. Some of them are going to have useful lives that really are not anywhere near what it should be the case. And so we're going to have additions that go on. So because of that, we have to simply add it to the asset count. There's no way around it. And we're going to simply take that new group rate by the total cost of assets. And so this really becomes sort of an ongoing activity if you use the group method. I'm not crazy about it, frankly, because I think today with software, we can handle depreciation. Whatever method we use, we can do it. We don't really need to do this particular shortcut, but it is used. And the key thing is there's no gain or loss required when these assets are retired or sold. This is something that we're going to talk about, particularly as we circle back here to talk about composite accounting. So any gain or loss is simply absorbed, and we simply credit the vehicle account. If it's vehicles, again, vehicles are probably a pretty good example of this, and so there's no gain or loss being recorded. Okay. All right, so I think that's a pretty good stopping point here. I know that we're not really that deeply into it. I know that I circled back to some of the concepts in chapter 10 simply because I thought they were really important, particularly in terms of how we get to book value. Because really, book value, chapter 11 deals with disposition of assets, where we're talking about a fair value somebody's willing to pay versus a book value that simply is an amount that is hopefully representative of future service value, but really, if it's net presented net of depreciation, depletion, or amortization, it's maybe not always reflective of what the market value might be. Whether the market value is higher or lower, right? If the market value is lower, we're going to talk about that issue as we get going a little bit later. So we're going to stop here because we're going to talk more about, and we're going to get into depletion and talk about that. I know that I'm not going to have any opportunity to get all the way through this particular discussion today or even on Tuesday. I'll do some supplementary videos before next week's assignments are due, just because there's so much to do here in terms of, particularly we haven't really gotten to depletion yet. We will get to that and talk about those. Depletion usually revolves around natural resources, coal, timber, whatever. And so we'll talk about that. So, all right. Any questions for me before we wrap this discussion up today? Okay. Well, I'm available all weekend. If you have questions for me, feel free to reach out, and I will see everybody next week.